During the months of April, there has been quite a few interesting news and price movements we wish to highlight. First, the Bank of Japan. Second, gold prices. And third, economic data. Let's start with the Bank of Japan. It announced a very ambitious quantitative easing program with a view to overcome deflation within the next 2 years. It will double the monetary base through purchasing of Japanese government bonds, de facto monetizing the huge budget deficit. Time will tell whether these actions will succeed, but they already lifted consumer and business sentiment, sending the yen lower and Japanese shares higher. As long as the resolve of policymakers remain firm, such trends will likely persist. And to some extent, global fixed income and equity markets will benefit from this liquidity tsunami. Second, gold. It is actually quite counterintuitive that just 1 week after the announcement of the Bank of Japan, gold price suddenly fell. We argue it is precisely because it once again failed to react to positive news, and Bank of Japan was positive news for gold, that poor investor sentiment crystallized into a sudden sell-off. The key issue for investors is to try to answer the question whether the 10-year bull market in gold is over or not. The answer is possibly yes, it's over, if central banks manage to remove monetary accommodation before inflation picks up. But alternatively, the answer could be no, it's not over, if inflation undermines confidence in paper currencies. Let's move to economic data. Recent releases were mostly disappointing, with China, Europe, where there is no sign of any improvement, and even the US, which was the area of strength in the first quarter. Given the strong fundamentals of the US, we expect the US economy to regain strength in the second half after having overcome the headwind from the higher payroll tax and automatic spending cuts. Given near-term economic data, which are disappointing, an equity correction is overdue and ongoing if you look at different markets and sectors. However, any sell-off, we believe, would be subdued and cushioned by very accommodative central banks. This is the reason why we stick to a neutral stance toward risky assets with a view to using our cash balance in an opportunistic fashion. For instance, the slide in commodity prices and related markets is starting to look overdone, and it might soon offer opportunities for profitable investments.